Well, this last week, the small corners of the financial world have been in the global news, and that's never a good thing. But so we thought we'd just spend a few minutes with some context of that and what we see from it. Last week, the 16th largest bank in the United States, called Silicon Valley Bank, failed, and the U.S. regulators had to step in to backstop deposits, and this spooked financial markets of all kind. More recently, in the last few days, the large European bank Credit Suisse has been coming under significant pressure. I'd say that's less of a news story. That's been going on for a year or more. Nonetheless, in this context of Silicon Valley Bank, the Credit Suisse story got dusted off as well, in the context of a market that at the moment is running a little bit scared of leveraged financial institutions. What got Silicon Valley Bank into trouble has to do with one of the factors that caused financial markets in 2022 to come under pretty much universal pressure, and that was significantly higher interest rates from the Fed and other central banks. So the Fed raised its target rate from 0 to, call it 5%, over just more than a year. That's a huge move by historic standards. And banks own assets, loans. In this case, Silicon Valley Bank had a lot of what we call long duration, long maturity bonds whose prices fell quite dramatically, corresponding to those increases in interest rates. So whenever problems happen in the financial market, investors can get a little bit spooked, and that's exactly what happened. The context I bring to this, though, is this. After such large interest rate moves in the US and elsewhere, it's completely understandable that we're going to see the long-awaited economic slowdown. And economic slowdown can involve what we call things breaking. And this is an example of something snapping and breaking. I think it means that the slowdown that we've been waiting for is upon us. And it means that the moment when central bank tightening, this aggressive raising of interest rates being done, is closer. So we're probably closer to a peak in interest rates. The flight to quality, as they call it in financial markets, started late last week and continued through much of this week. A lot of seesawing of volatility. By flight to quality, we mean things that are causing investors to move to some of the safest assets. And the safest assets in the US financial markets are very short-term treasuries. And as an example, in the last week, US two-year treasury notes saw their yields move from 5% last Wednesday to where they are today at around 4%. And as interest rates fall, prices of bonds correspondingly rise. So these prices have been increasing and very volatile in the last week. Just a window into how keen investors are to move from riskier assets into what they perceive to be the safest. So what does this mean for investors? The analogy here that we like to use, that we're thinking of at the moment in terms of what does an economic slowdown look like, especially one that everyone's been expecting for so long, is kind of like if we're here in Barbados standing at the top of Cherry Tree Hill and we're looking east. It all feels also nice and peaceful. But contrast that to when you're standing down at Catawash with your feet in the water. That feels quite different, doesn't it? And I think this period of slowdown that we are probably seeing here this year, that may go on for a few more months or even longer, is going to have episodes like this that feel vivid. But the way we're thinking about it, and the way we would encourage others to think about it, is to imagine you're on top of the hill looking at something peaceful, because that's exactly what's happened. There are going to be more things like this, and they're going to probably bring, the silver lining is they'll bring the central banks closer to ending the aggressive tightening. But nonetheless, this is just what a slowdown feels like. There'll be more like this, but it's not out of the ordinary at all. Where does this then leave us for the future? So again, we expect choppy markets for the next period of time as the economic slowdown happens. But the opportunities for investment in bonds at the moment, with global bonds in the US yielding 4 to 5% for high quality securities, we think is still better than it's been in a decade or more, so still very good. And it's a big world. There are many very, very reasonably valued high quality securities to own, and we've invested in many of them in our portfolios. So we still think the outlook long term is quite good. But again, just get ready for more news like this, because it's unlikely this is the last thing we'll see. And we should just imagine ourselves at the top of the hill looking at the peaceful scene, as opposed to down in the water as the news will try to make us feel. So that is it from here for now.